What's up, everybody? Crypto Noah back with another fire yield farming video. In this video, we're going to talk about, should you hodl or should you yield farm, or maybe should you do both? We're going into a bull market, so a lot of people don't want to miss out on the returns from altcoins mooning, but they also don't want to miss out on the high yields from the volume on the dexes from the altcoins mooning. So in this video, I'm going to talk about the pluses and minuses of doing either or, and what I think the best way to go about it is in terms of your portfolio's benefit. All right. So before we get started, I do have to say that none of this is financial advice. These are my own perspectives, research, and opinions, and they should be treated as such. So without further ado, let's jump straight into the content, starting off with, what is yield farming anyway? So there's multiple ways to yield farm. You can deposit your tokens on a borrowing and lending platform to get a yield, like Aave and Compound. The platform facilitates the lending and they pay you a supply APY. You can stake your tokens on insurance platforms like Nexus Mutual and get paid passive income for providing liquidity for insurance premiums. You can stake on a blockchain's validator network like the E2.0 beacon chain, and you get paid a yield to help secure the network. And the way we're going to talk about in this video, the way I talk about on my channel, the most profitable way to yield farm when done correctly is to provide liquidity on decentralized exchanges in the form of pairs. So yield farming is nothing new. It's been going on since the 19th century. Every market needs a market maker. Stock markets, bond markets, commodities, precious metals, crypto. They all have market makers. Large companies like Credit Suisse, Deutsche Bank, Morgan Stanley, Goldman Sachs will come and say, hey, here's $50 million in Tesla. Here's $50 million in cash. Only use our liquidity when the price of Tesla is between X and Y. And they profit off of what's called the bid to ask spread, aka they make passive income when the market's going up or when the market's going down, because they're getting paid off of trading volume, buying and selling volume, doesn't matter. All right, so now that we know what yield farming is, let's dive into the meat and potatoes of the video. So like I said in the beginning, we're going into a bull market and volume is increasing on decentralized exchanges, which means yields are increasing. To show proof of this, you go over to Uniswap and you can see how the TVL has been increasing after we had the steep fall off due to the FTX and BlockFi Celsius debacle, but you see we've been trending upward. Same thing here, volume decreased significantly. It was stagnant for a while and now we're seeing volume starting to increase as well. TVL and volume increasing. So like I said, people are wondering if should I yield farm and take advantage of the yields, or should I just hodl and wait for prices to go up? People who want to yield farm, they don't want to miss out on the hodl profits due to impermanent loss. But I've made a video and plenty of videos explaining how you can make impermanent loss your best friend, and a lot of strategies that I implement, the more impermanent loss I get in the short term, the more I win in the long term. And then people who want to just hodl don't want to miss out on the great gains while they wait for prices to explode upwards. Now, which one should you do? In my opinion, if you know how to yield farm, you guys heard me say on my channel, if you watch any of my videos, it's the best way to generate passive income in the history of mankind for 99.9% of people. And the exception is if you know how to build an algo. But even then, you're going to lose money at first because you have to test it out. So I say you should do both. As you guys know, or if you didn't know, I use 25% of my portfolio to yield farm with, and I use it as a tool, not the end all be all. You don't have to do one or the other. And I think it's best if you do both. Proof of that, look at market makers. Market makers have been doing this since the 19th century, and they wouldn't be doing it for this long if it wasn't profitable, right? If you look at their balance sheet, they don't do market making or yield farming with their entire portfolio. They reserve a portion for market making. They have a portion in cash to buy the dip or deploy cash. And then they have another portion in assets, right? And they rebalance their portfolio on at least a quarterly basis. This is also a biblical portfolio management technique. And I made a video diving through this, in detail, but it doesn't matter if you're religious or not. The principles in the Bible, it has proven to work and they've proven to be timeless. So basically what it is the first person that God said was rich in the Bible was Abraham. And he didn't just say he was rich, he said he was very rich, and he said what he was rich in. Investment portfolio, he was rich in silver, gold, and livestock. Now, if you translate this to the modern day portfolio, silver is our cash. Silver back then was used as a medium of exchange to, make small purchases. Gold was a speculative asset. It was also used for larger purchases. And this is kind of like our Bitcoin, our stocks. And then livestock is your cash flow. So you have your goats, you have your cows, you're selling milk, you're selling wool, you're selling, whatever you sell when you have a farm, chicken eggs, and you're making money in gold and silver so you can buy more livestock and then you sell it for more gold and silver. So it's literally mixing them both together. And with yield farming, it's the same thing. You take your rewards, you can use it to buy more cash and more assets. And then when you rebalance and you take profits on them, your yield farming portfolio will represent a larger portion in your portfolio. And the cool thing about it is these three things, asset, cash, and cash flow, they all have their own seasons in which they shine. Cash shines when prices are low, so you can buy things for cheap. Assets shine when prices are high, so you can sell them at high prices for more cash. But cash flow is like a Swiss Army knife. It shines at all times. There are yield farming strategies for bull markets, bear markets, and sideways markets that we teach in our course within our community and our coaches. If you're interested in that kind of thing, click the link in the description. You can book a free strategy session and we'll see if it's a good fit for you. I digress. Cash flow is good because you're always able to accumulate more cash to deploy and more assets to sell. So here's why doing both the right way works. So let me first explain the pitfalls / missed profits for doing only one. If you're only hodling, okay, great. Assuming you have a take profit strategy, a plan to get out before you get in, which you should, you're going to be waiting for God knows how long until your price targets are hit. All the people who are like, oh, why would I yield farm and I can just hodl and make more money? Oh yeah, so you're going to sell the tops every single time? I don't think so. That's literally impossible. You have to worry about capital gains. It's a lot of factors at play versus picking a range where you think price is going to be at. And as it's going up and down, you're making passive income. And then as it breaks and retests, and you have a nice green candle close on the weekly, monthly, even better, then you can adjust your range. So that way, when you do sell, you'll have more to sell and you'll make more money, which means you can yield farm with more, which means you'll make more rewards, which means you'll have more assets to buy, you'll have more to sell. It's literally a positive self-reinforcing cycle. Now, let's say you're only yield farming, right? I've made videos talking about why I never compound my rewards back into the pool to increase my APY. But let's say you're doing that and you're only yield farming and all you care about is the yield. Eventually, price is going to go out of your range, and then impermanent loss is going to put a cap on the profits you can make because you're not taking those rewards and hodling any of them so that you can experience the actual price appreciation of your assets that you're buying. So you'll be happy with the yield you're making until you go out of range, and then let's say that asset that goes out of range 100x's and now you're left with the underperforming asset. You're going to be real upset no matter how high of a yield you were getting. So now that you know the pitfalls of doing one and not the other, let's talk about why it's good to do both. And let me show you the math and show you why doing both is the most profitable way to go. So like I said, assets, cash, and yield farming have their own seasons when they shine, right? The market can only be doing three things at once. It can be trending upwards, it can be trending downwards, or it can be chopping sideways. Now, you have no idea when markets are going to soar. You have no idea when they're going to dip, or you may have some kind of idea, but you're not going to be able to time it every time. Most of the time, you won't be able to time it. You can set limit orders, but what if it goes down and goes back up and now you miss out on price appreciation? Like, there is no perfect way. No one knows exactly what's going to happen in markets, right? So it's good to have a strategy so that you can take advantage of no matter what the market's doing. And yield farming allows you to do that. So while the market is consolidating, which it does most of the time, you're accumulating. And then when the market booms, you make way more money, assuming you're not compounding and you're claiming your rewards. And when the market drops down some, there are yield farming strategies for down markets. But let's take away that case scenario. If it drops, well, hey, you have more assets, so your portfolio is not going to take as big of a hit. So you don't lose as much when it goes down and you make more when it goes up. What more can you ask for, in my opinion? And the cool thing about yield farming is that the mainstream banks and financial institutions that are yield farming or market making and TradFi, they're not legally allowed to provide liquidity in DeFi. So you can set really wide ranges and still make triple digit APYs right now because these firms aren't saturating all of the yields with their billions of dollars. So the name of the game is accumulate while you wait. Now let's check the math to see the validity of what I'm saying. So if we go over to revert.finance, this has been like my case study pool that I've been talking about for a while. You can see that I got in it 76 days ago. My range is 88%. So anytime price is between this blue line, this is Maple and ETH, I'm making money, right? And if I measure from the bottom of this blue line to the top of this blue line, you can see that it's around 89, 90%. It's a pretty wide range to be making 259% APR after 76 days. And keep in mind, these prices right here is based off of current prices. At current prices, the market has dipped down at the time of this video. It shows that I pulled out around $5,000, but when I pulled out, it was more like $6,500 because we were up. And since I rebalanced, you can see that I've made around $2,000, $2,100, $2,200, but I'm not going to claim until things go back up. And I'm actually going to claim these rewards since the market's down, and I'm going to use my Ethereum to either buy more Maple or buy more altcoins so that once they go back up, I'll be able to take more profits, right? So just to do the math on this, I made a video on Maplefinance telling you guys how I plan on turning like $15,000 into $1 million. So let's say I'm just getting 100% APY, right? When I originally deposited into this pool, it was 12K. Now, if I'm getting 100% APY and I'm in this pool for 6 months, that means I just accumulated $6,000. But you guys know I made $6,000, $6,500 in just 1 month, not including my principal. The principal went up to 17K. So I actually ROI'd in this pool in like a month and a week. So I'm playing with house money here. But let's just be conservative. Say I accumulate $6,000 at Maple. Well, guess what? I can take my ETH, use it to buy more Maple, send it to my HODL wallet, and now I have it with the rest of my bag. And that 6K versus compounded in there, and then once Maple moons, I'm in 100% ETH. ETH is not going to outperform Maple in this bull market, I believe. I'll be able to turn that 6K into 6 figures, 200-300K, if Maple does what I think is going to do. Then when I go to rebalance my portfolio, I can take some of those profits and have more to yield farm with, which means more rewards, which means more assets, which means more profits, which means more yield farming, liquidity, rinse and repeat, rinse and repeat. So with that, I'd like to conclude this video. Like I said, if you want to learn how to deploy the same market making strategies that institutions have been deploying profitably for centuries, click the link in the description, book a free strategy session. You'll talk to me or one of our coaches, and you will have the chance to learn about our Know It All Academy yield farming course, which I think is the best one on the market. And if you do decide, just know you'll be able to get mentoring by professional coaches who do this for a living, as well as an elite community who all have each other's best interests and who's trained to find opportunities to bring them to the group so we can all benefit. But with that, I like to put a bow on this video. If you got value, I ask that you consider subscribing, drop a like, drop a comment. Help me reach 2K if I haven't already by the time this video is posted. Other than that, I thank you for tuning in. I love every single one of you watching, and I'll see you in the next video. Take care and farm safe.